Types of stocks you should generally avoid, and why. 1. Companies with consistently declining revenues and earnings. If a company's sales and profits shrink year after year, that's a red flag. Why? Declining fundamentals usually signal weak demand, poor competitive position, or internal problems, and the stock often follows. 2. Highly leveraged companies in a rising rate environment. Companies with lots of debt, high leverage, struggle when interest rates rise. Why? Higher borrowing costs can squeeze profits and increase the risk of default. 3. Hyped stocks without real business models. This includes IPOs or story stocks priced based on buzz instead of fundamentals. Why? Prices can crash once the hype fades if there's no real revenue or profitability. 4. Penny stocks or illiquid stocks. Stocks that trade at very low prices, e.g., under $5 per share, and low volume. Why? They're often volatile, easily manipulated, and harder to sell without losing money. 5. Companies in structural decline. Industries that are shrinking due to technology or consumption changes. Examples: generic categories, DVD rental companies versus streaming, traditional print media losing readers to digital. Why? Even a cheap stock can continue falling if the business is fading. 6. Management with poor governance. If a company has a history of fraud, repeated warnings by auditors, or CEO or board conflicts of interest. Why? Bad governance often leads to investor losses and legal trouble. 7. Companies dependent on one customer or one product. If a company relies on a single customer or one product for nearly all revenue. Why? Losing that customer or product relevance can collapse the business. Practical checklist before buying a stock. Growing or stable profit. Consistent increases over years. Manageable and decreasing. Positive and stable. Favorable or expanding. Not overpriced compared to peers. Adequate daily trading volume. Transparent and shareholder-friendly management. Important notes. Risk tolerance differs. What's unsuitable for a conservative investor may suit a high-risk trader. Never base decisions on memes or stock tips alone. Diversification matters. Don't put all your money in one company, especially a risky one. This guidance is educational only, not financial advice. Like, comment and share this video.